Hey guys, welcome to Make Money Count. The Bank of Canada did their announcement yesterday. No changes. Nothing happened. A lot of people were upset about it. And, upset. The people with variable rates were upset.
50% of people were surprised. 50% of economists were surprised because there was a 50% chance that they were going to drop interest rates by 25 basis points.
Right.
So we're going to do a 10-minute quick crash course on what the Bank of Canada did, what they said, how it impacted bond yields, and what you should do about it with your mortgage.
Love this.
Okay, so first off, CPI numbers came in earlier in the week.
Mm-hmm.
Inflationary reading for the month of March for Canada. A little bit lower than what was expected, 2.3%. Pull up the chart. Yeah, okay. So CPI number comes out and it is lower than it was for February in March. And we're going to put the chart up. Hopefully you can see it right now. You can see Loblaws. The Loblaws CPI component, food.
Yeah.
Up. I'm sure they're going to blame that on tariffs, but probably it's going to be reflected in their profits for the quarter. Shelter is falling. Again, that's interest rates decreasing, rent year over year, month over month decreasing as the economy shrinks, as unemployment rises, as tariff uncertainty starts to really kind of root itself into our economy.
Mm-hmm. People really put the brakes on buying Jordans.
Clothing and footwear, way down.
Yeah, way down.
Transportation down. Nobody moving around, like less people traveling to the United States for sure. Like to see alcoholic and tobacco products still doing well there with the cannabis. Way to go.
Yeah, they really took a hike.
That's something we call inelasticity of demand.
Right.
Anyways, it's just to say that and then the big piece here is that gas prices, obviously, gas prices dropped, carbon tax, and generally speaking, the price of oil is dropping.
I don't know that like substantially lowering the amount of money spent on education and substantially increasing the amount of money spent on, or the price of, alcohol and cannabis is a great thing, but that's okay. These things happen.
Yeah.
Some people need a break.
I mean, maybe it's kind of clearly indicative of the market that we're in.
Yeah,
right now,
exactly.
right?
Exactly.
Yeah. So we saw this translate the Bank of Canada's decision. And keep in mind, right, the Bank of Canada just decided not to drop 25 basis points now, right. In April.
Yeah.
But they're meeting again in June and they're meeting again in July.
Yeah.
And I wouldn't say it's 100%, but all things being equal, I mean, I would be more than happy to take anyone's bet that I believe we're going to see 25 basis points in June and 25 basis points in July.
Double down.
Yeah. So if you want to bet me, I'm willing to take that bet.
Let's call the office.
Only very interesting bets though. Like, Justin will wear a tutu to the next podcast in July if the June rate meeting doesn't hit. We don't get a 25 basis point drop. So the overnight rate is at 275. The prime rate is at 495. The best 5-year fixed rate on the market is 3.75. What do you do? Before we can answer that, let's look at the bond yields. Put them up. Okay, 2.7%. 2.7%, roughly speaking, depending on when you're going to see this. It's a little higher than where it was. We were kind of in the 2.5 mark. As we have said previously, 5-year fixed rate mortgages are all priced off of the bond yield between 1.25% and 1.5%. When banks are greedy, maybe 1.75%.
Yeah.
So when you see that we're at 2.7 and we got a 5-year fixed rate at 3.75, that means it's a good rate, low spread. Mm-hmm. They want to entice you over to that 5-year fixed rate product.
Yeah.
I am still advocating for a variable rate mortgage. I think that, so right now you're at 4.95 on the prime rate. We're going to go to 4.5, probably within the next few months. I don't know that we're necessarily going to see bond yields come off that much.
Right.
I also don't think we're going to see them spike. I think
I mean, it doesn't matter what bond yields are once you're locked into a 5-year fix, right?
Yeah, no, but I'm just saying, like, I'm trying to debate a variable rate versus a fixed rate. If you recall the start of this,
what I'm saying, if you take a variable rate, you're not gonna, if you take a fixed rate, you're not gonna ride the
variable rate
roller coaster,
right? So I just think what we do is try to provide a strategy for the viewer, right? So what I'm thinking, and hear me out, because we haven't talked about this.
I'm interested.
We didn't rehearse this.
No, we did not.
Right. Okay, so here's what I'm thinking.
Okay, go.
I think, although the fixed rate, which is priced off of the bond yield, although the bond yield sits at 2.7 and the spread is quite tight to the 5-year fixed rate at 375, I think there is still downward movement in the bond yield.
Right.
I think that we're going to settle on a bond 5-year yield in the 2.3, 2.4 range after the next 50 basis points of cuts comes through. I think that the anticipation that inflation is going to seep into the Canadian economy, that fear, I think, is overblown. I think if it does seep in, it will be temporary, and it will be affected significantly by the recession that we're going to head into.
Right.
So I think that, and if that inflationary pressure doesn't come into the Canadian economy, it means that the tariff uncertainty is lifted.
Right.
Which is a good thing for the Canadian economy, removes that uncertainty and helps the economy begin to grow. But that growth doesn't happen immediately.
Right. It takes some time.
And you've got a bit of a runway to make that decision. All of this is to say is I still think it's like that Braveheart scene that I reference all the time, where Mel Gibson is like telling his troops to hold.
Right.
I think like if you're making a decision right now about your mortgage, I think you still have to look at taking a variable rate product. I think that it gives you the opportunity to like win 2 or 3 times, right? Like be on the winning team. I think that'd be good for people's psychology. Like be in a variable rate, watch the rate drop 25 basis points in June, watch it drop another 25 basis points in July, see it drop another 25 basis points before the calendar end of the year. Now you're going to be in
2 more times.
Yeah.
Or
two. So then you'd be at like a 395 prime, 295 variable rate. Mm-hmm. Maybe at that point, the bond yields are in that 2.3 to 2.4% range, which means a 5-year fixed rate sub 3.5, and then you lock in.
Yeah. Jump ship.
The reason why I say I would avoid the 5-year fixed rate still right now is because most of the probable paths for the Canadian economy involve lower interest rates. The only kind of outlying probabilities, or like the only kind of outlying paths that we could take would be, one, let's say that we get tariff certainty right away, which I don't think is going to happen, and the inflationary pressure that we were expecting from tariffs doesn't materialize, but we get inflationary pressure from huge economic growth because Canada now starts supplying more goods to the United States and the relationship is no longer fractured and the Canadian economy starts to fire again. Even if that does happen, I do believe that will happen. I just don't think it's going to happen
tomorrow
in the short term. Yeah. I think it's more of like a 12, 18, 24 months down the road thing. Then the other possibility that could lead to rates going up would be that this tariff uncertainty creates inflation. That inflation becomes more rooted in the Canadian economy. And then as a result, the Bank of Canada gets their hands tied and has to keep rates where they are or increase them. The reason why I don't see that as probable, number one, the recession that would create would dwarf the inflationary pressure, right, and would ensure that the inflationary pressure is temporary. And second, in the event that this tariff uncertainty stays for longer and inflation is to root itself in the Canadian economy, you need to see wages increase. And wages don't increase when unemployment is rising.
Right.
So there's kind of like a fail safe, like a switch, like a circuit breaker that is going to be inherent in any type of inflation that's trying to root itself in our economy, because wages just can't go up. Because if employees demand more wage, they can be replaced. So both of those two factors, I think, eliminate that as a risk.
Right.
As a result, I think, and a lot of people are saying, like I've seen a bunch of different podcasts, and a lot of these people are saying, take a fixed rate mortgage now. And I think that obviously it's because the bond yield is at 2.7. I just think we got further to go on the bond yield. Remember, right? Like that bond yield is the risk-free rate that Canadians and international investors are willing to accept. And in times of uncertainty, they will accept less, as there is a flight to that safety.
Yeah.
So I think it's a safe bet to say that we're going to see more downward pressure on that.
Awesome.
So all is to say, strategy going forward, variable, with an eye towards pivoting to a fixed, which means you probably don't want to be with a big bank.
Right.
Because we know what it's like when you're switching from a variable rate.
Which we will talk about in a second.
Yeah.
Yeah.
We know what it's like when you're switching from a variable to a fixed with a big bank. You're going to get screwed.
Yeah.
And when you're trying to break a fixed rate mortgage with a bank, guess what else? You're going to get screwed. So try to find the best possible lender. Remember, like whoever your mortgage lender is your partner in that mortgage for at least the duration of that mortgage, and hopefully forever. Hopefully you're not shuffling your mortgage around from place to place.
Yeah, that's a good point. And And I'm excited to talk about that on our next podcast, which we're going to discuss renewing your mortgage.
Yeah.
Yeah. Thanks so much. I was about to say everything that he just said, but he cut me off, so that's okay.
Yeah.
We'll see you next time.